When I first learned the market, I learned it the hard way, by letting it take my money when I was in too much of a hurry to be right. And that's the thing about fake breakouts. They look like opportunity, they smell like easy money, and they show up just when a trader's patience is wearing thin. You ever notice how that happens? You sit there watching price press against a level for hours or days, and the moment it pokes its head through, your heart speeds up and your hand wants to click the button. That's when the market starts whispering lies. A real breakout doesn't need to shout. It doesn't need fireworks. It moves with quiet authority. Fake ones, though, they come in loud and dramatic. Big candles, sudden volume, all designed to stir the crowd. And who is the crowd? Small traders, emotional traders, the ones who feel like if they don't act right now, they'll miss the move of a lifetime. Have you ever felt that pull, that pressure to chase? That's not instinct. That's the market playing on your impatience. Livermore always said that the big money is not in the buying or the selling, but in the waiting, and nowhere is that more true than around breakouts. When price pushes through a resistance line, most people think the job is done. But that's just the opening act. The smart money is watching how price behaves after the break. Does it hold? Does it drift back? Does it snap back violently like a rubber band? Those little reactions tell the whole story, if you're calm enough to read them. A fake breakout is really just a trap. The market pushes past a level just far enough to pull in all the eager buyers or sellers. Then it turns and runs the other way. And who gets caught? The ones who bought the high or sold the low, thinking they were early. But early is usually just wrong in disguise, isn't it? The market doesn't reward speed, it rewards correctness. I learned to treat every breakout with suspicion. Not fear, just healthy doubt. When price breaks, I ask one simple question. Who is really in control here? Is it the strong hands, the big operators who can push price and keep it there? Or is it the weak hands, jumping in because they're afraid of missing out? If price can't stay above a breakout level, that tells you the buyers didn't have the strength to hold it. And when buyers can't hold, sellers are already sharpening their knives. Think about it this way. If a breakout is real, it shouldn't need to be rescued. Price should move away from the level with purpose, not creep back toward it like a guilty dog. When you see price break out and then drift right back into the old range, that's the market saying, not yet. Do you listen when it says that, or do you argue with it? Most losing traders argue. They say, it has to go up now. Look at the chart. It broke out. But the chart doesn't owe you anything. It doesn't care about your opinions or your hopes. All it does is record where buyers and sellers are willing to do business. And when a breakout fails, it's recording something very important, that the crowd got it wrong. Fake breakouts are especially cruel because they come right when confidence is highest. After a long consolidation, traders are bored. They want action. So when price finally jumps, they all pile in at once. That rush creates the illusion of strength, but it's really just a wave of emotional money. The professionals sell into that wave. They let the public do the buying for them. Doesn't that make you wonder who you're really trading against? The trick is not to predict whether a breakout will be fake or real. The trick is to wait for the market to prove itself. Let it break. Let it pull back. Let it show you whether it can hold that new ground. If it can, you have a real move. If it can't, you have a trap. That's not complicated, but it takes discipline, and discipline is rarer than any chart pattern. This ties straight into your money mindset. When you chase fake breakouts, you're really chasing excitement. You want the thrill of being in a fast move. But trading is not about thrills. It's about taking small, controlled risks when the odds are in your favor. Every time you wait for confirmation, you're telling yourself that your capital matters. You're acting like a professional instead of a gambler. Isn't that the kind of trader you want to be? I used to lose more money being early than I ever did being wrong. Being wrong, you can fix with a stop. Being early just keeps you stuck while the market works against you. Fake breakouts prey on early traders. They get in at the worst possible price, right when the market is about to turn. Then they sit there, hoping while the loss grows. Hope is expensive in this business. Look at any chart and you'll see it. Price pokes above resistance, everyone cheers, and then the next few bars sink right back below it. That's the tell. That's the market sweeping the stops and collecting the orders. When you see that kind of rejection, that's not a buy signal. That's a warning sign. Do you take warnings seriously, or do you ignore them when they're inconvenient? The market always leaves clues. Fake breakouts usually happen on thin follow-through. You get the break, but no real push afterward. Volume dries up, price stalls. It's like a car revving its engine but not moving forward. That's when you know the move is hollow. A true breakout has momentum behind it. It doesn't look back right away. Protecting your capital means respecting these small details. Every dollar you don't lose on a fake breakout is a dollar you can use on a real move. That's how wealth is built in trading, not by hitting home runs, but by avoiding stupid losses. You don't need to trade every breakout. You only need to trade the ones that hold. And there's another side to it. When fake breakouts fail, they often create some of the best trades in the opposite direction. Once all the breakout buyers are trapped, price can fall fast as they rush to get out. That's when the real money starts moving. But you can't see that if you're already stuck in a losing position, can you? So you learn to wait. You learn to let other people be wrong first. That's not weakness. That's strength. It takes confidence to do nothing while others are jumping in. It takes faith in your method, and faith in the idea that the market will always give you another chance. Because it will. There's always another trade, but there isn't always another dollar if you keep wasting them on fake moves. Every fake breakout you avoid is a small victory. It keeps your mind clear and your account intact, and over time, those small victories stack up into something that looks a lot like consistency. Isn't that what we're really after in this game? Volume without follow-through often marks a trap, because volume by itself is only half of the story, and the market is always telling its story in two voices at the same time. One voice is how many people are trading, and the other voice is what price does after they trade. When those two voices don't agree, something is wrong, and that something usually costs traders money. You see, heavy volume looks impressive on a chart. It makes a candle look important. It makes the move feel serious. But if price does not continue in the direction that volume suggests, that volume was not strength, it was activity, and activity is not the same thing as control. A lot of traders see a big green candle on high volume breaking above resistance, and they think, this must be real. But what they are really seeing is a rush of orders, not necessarily a rush of conviction. People can buy for many reasons. Some buy because they see a breakout. Some buy because they are covering short positions. Some buy because a news headline scared them. But only one kind of buying actually pushes a trend forward, and that is buying that is willing to keep paying higher prices. If that willingness is missing, price stalls, and when price stalls after a burst of volume, the market is quietly telling you that the move was hollow. Think about what follow-through really means. It means that after the breakout candle closes, the next candles keep moving in the same direction. They don't hesitate. They don't drift sideways. They don't slip back into the old range. They step forward. That stepping forward is proof that new money is still coming in. Without that, the first burst of volume was just the opening of a door that nobody walked through. This is how traps are built. The market shows a big volume spike, price jumps, and all the breakout traders feel justified. They jump in late, thinking they are riding a wave of strength. But behind the scenes, the people who bought earlier are using that volume to sell into them. They are unloading positions into the excitement. That selling absorbs the buying pressure, and that is why price stops moving even though volume was high. From the outside it looks like something powerful happened, but inside it was just a transfer of risk from smart money to emotional money. When you understand this, you stop being impressed by volume alone. You start asking a different question. You ask, what did price do after the crowd showed up? If the crowd came in and price barely moved, that tells you the other side was strong enough to hold them back. That is not bullish. That is distribution. It is a quiet unloading of inventory, and it leaves the late buyers holding the bag. This is especially common around obvious chart levels. When a resistance line is clear, everyone sees it. Everyone waits for it to break. When it finally does, volume explodes because thousands of traders are acting on the same idea at the same time. But because it is obvious, the professionals are already positioned for it. They know the orders are coming. They know where the stops are. They know where the breakout traders will buy. That is where they sell. The volume is not supporting the breakout. It is being used to fill large sell orders. If follow through were real, price would keep climbing because there would be more buyers than sellers even after the initial rush. But when you see price hesitate or reverse right after that volume spike, you are seeing the true balance of power. The sellers have met the buyers and matched them. Once the buyers are used up, price has nowhere to go but back down. This is why volume without follow through is more dangerous than low volume. Low volume tells you nothing is happening. High volume with no progress tells you something very important is happening, and it is not what the crowd thinks. It is the market showing you that a battle took place and the breakout side did not win. From a trading mindset perspective, this is where patience saves you. The impatient trader buys on the volume spike. The disciplined trader waits to see if price can hold. That waiting costs nothing. There is no penalty for watching one or two candles after the breakout. But there is a big penalty for being wrong early. When you wait for follow through, you let the market prove that the volume meant something. You are no longer guessing, you are observing. And this ties directly into how you treat your capital. Every trade is a business decision. If you buy just because volume is high, you are running your business on excitement instead of evidence. High volume is like a loud advertisement. It grabs attention, but it doesn't guarantee quality. Follow through is the quality. It is the product actually doing what it promised. Look at failed breakouts on any chart, and you will see this pattern again and again. Big volume, big candle, and then nothing. Or worse, a slow drift back below the breakout level. That slow drift is where hope lies. Traders who bought the breakout keep telling themselves it will go back up. But the lack of follow through already told the truth. The move was never strong enough to continue. The best trades come after the crowd is proven wrong, because markets move on imbalance, not on agreement. When everyone sees the same thing and believes the same story, the trade is already crowded, and crowded trades don't have much room to go. They are like a packed elevator that can't take another passenger. But when the crowd is wrong, when their positions are leaning one way and price starts to move the other, that's when the elevator suddenly drops and all that trapped weight turns into momentum. You see this most clearly around obvious setups. A chart builds a neat pattern, maybe a range or a well-defined resistance level, and everyone is waiting for the breakout. The moment it happens, the crowd jumps in together. They buy the same spot, place their stops in the same place, and think they are finally on the right side of the market. But that uniformity is exactly what makes them vulnerable. If price slips back below that level, all those traders are instantly wrong at the same time. When a lot of traders are wrong together, something powerful happens. They don't just sit calmly and accept the loss. They react. Some panic. Some freeze. Some hit their stops. Some manually close their trades. All of that creates orders. And those orders push price in the opposite direction of their original belief. That is where real movement comes from, not from people being right, but from people being forced to admit they were wrong. This is why failed moves are often more important than successful ones. A breakout that holds may give you a slow, steady trend. A breakout that fails gives you fuel. It creates urgency. It creates pressure. The crowd suddenly realizes the story they believed is not true, and they have to do something about it. The market feeds on that. A trader who understands this stops trying to be part of the crowd. He waits for the crowd to commit, then he watches to see if they get rewarded or punished. If they get rewarded, he can join later with less risk. But if they get punished, that's where the best trades hide. That's when price starts to move with purpose, because it is being pushed by emotion and necessity, not just hope. Think about how it feels to be wrong in a trade. You feel trapped. You feel like you need the market to turn back in your favor. But when it doesn't, you eventually give up. Multiply that feeling by thousands of traders, all wrong in the same place, and you begin to understand why price can suddenly move so fast. It is not just new sellers coming in. It is old buyers rushing to get out. This is why the cleanest moves often come after messy ones. The mess is the crowd getting confused. They bought, it didn't work, and now they don't know what to do. That confusion creates volatility, and volatility creates opportunity for the trader who is not emotionally tied to the original idea. From a money mindset point of view, this teaches you humility. You stop trying to be the first to spot a move. You stop trying to prove you are smarter than everyone else. You let the market show you who is wrong, and then you simply follow the pressure. That takes ego out of the equation. You are no longer saying, "I think this will go down." You are saying, "They were wrong, and now price is reacting to that." This approach also protects your capital. When you wait for the crowd to be proven wrong, you are not buying at the highs or selling at the lows. You are entering when the market has already started to move away from a failed idea. That gives you better positioning and clearer invalidation. If the move is wrong, it won't take long to know because it will snap back into the old range. But if it is right, it often runs far, because there are so many traders on the wrong side who still need to get out. Look at any strong reversal, and you will usually find a failed breakout or a failed breakdown just before it. The market tried to go one way, convinced a lot of people to join, and then turned. That turn is where the story changes. That is where the best trades begin, not at the start of the original move, but at the moment it proves false. This is also why chasing is so dangerous. When you chase a breakout, you are joining the crowd at the worst possible time. You are buying right when everyone else is buying. There is nobody left to buy after you, and that means price has no support. But when you trade after a failure, you are trading with pressure on your side. You are selling to trapped buyers or buying from trapped sellers. That imbalance is what moves price. You start to see the market less as a place to predict and more as a place to observe. You watch how people behave. You watch how price reacts to their behavior. And when their behavior fails to produce the result they expected, you know a shift is happening. Waiting for confirmation protects trading capital in a way that nothing else really can, because in this business your first job is not to make money, it is to keep from losing it. Every trader says they understand that, but most don't trade like it. They act like the market owes them something the moment a setup appears on the chart. They see a breakout forming, or a support line getting tested, and they rush in before the story is finished. That rush is what drains accounts over time. Confirmation is simply the market agreeing with your idea. It is price saying, "Yes, this direction is right." Until you hear that yes, you are just guessing, and guesses cost money. When you wait for confirmation, you allow the market to show that there are real buyers or sellers behind the move, not just a few nervous traders poking at the price. A lot of people confuse early with smart. They think the trader who gets in first is the best trader. But in reality, the trader who gets in when the move is already proven is the one who lasts. You don't need to buy the bottom or sell the top to make money. You need to buy after the market has started to move up and sell after it has started to move down. That small delay is the price you pay for certainty, and it is a cheap price compared to the losses that come from being wrong. Look at how many losing trades come from ideas that were technically right but poorly timed. A trader might say, "This stock was supposed to go up." And maybe it does, eventually. But he bought before the confirmation, sat through a drawdown, panicked, and got out right before the move actually started. Confirmation would have kept him out of that emotional mess. It would have told him when the real buying began. From a capital standpoint, waiting keeps your risk small and controlled. When you enter after confirmation, your stop is usually clearer. You know exactly where the trade is wrong. If price breaks out and then pulls back and holds, you can place your stop just below that hold. If it fails, you lose a little. If it works, you can ride the move. That kind of structure is what keeps your account alive. Without confirmation, stops become guesses too. You don't really know where the market is wrong, because the market hasn't even said it is right yet. You are just hoping, and hope is not a strategy. There is also a mental benefit to waiting. When you wait for confirmation, you trade with more confidence. You are not constantly wondering if you jumped the gun. You are not staring at every tick, afraid the market will turn against you. You entered because the market showed strength or weakness. That makes it easier to sit through normal pullbacks and noise, which are part of every real trend. Most traders lose not because their ideas are bad, but because they can't sit still. They see a potential move and they want to be in it right now. They are afraid that if they wait, they will miss it. But missing a trade is not a loss. Taking a bad trade is. Waiting filters out a huge number of bad trades, and that alone can change a trader's results. Think about fake breakouts. They look perfect in the moment. Price pops above resistance, volume jumps, and everyone buys. But then price falls back. If you waited for confirmation, you would have seen that it couldn't hold. You would have stayed out, and staying out is just as important as getting in. The same thing happens with breakdowns. Price slips below support, sellers rush in, and then it bounces right back up. Confirmation would have kept you from selling into that trap. It would have shown you whether sellers actually had control. Over time, this waiting becomes a habit. You stop feeling the need to trade every move. You start trading only the moves that prove themselves. That selectivity is what separates consistent traders from frustrated ones. Waiting for confirmation also helps you scale up safely. When you have a method that keeps you out of low probability trades, you can trade bigger without fear. Your capital is not being chipped away by random guesses. It is being used only when the odds are in your favor. This is how wealth is built in trading. Not by taking more trades, but by taking better ones. Every dollar you don't lose on a bad entry is a dollar that can work for you on a good one. That is compounding in its simplest form. A trader who waits for confirmation is telling the market, "I respect you." He is not trying to force his will onto price. He is letting price lead. That attitude keeps you on the right side of big moves, because big moves always start with clear confirmation. You start to see charts differently. Instead of looking for where you want to buy or sell, you look for where the market has already shown its hand. You look for holds, re-tests, and strong closes. Those are confirmations. They are the market saying that it means what it is doing. When you align yourself with that, you stop fighting. You stop trying to outsmart the market. You just follow it, and following is much easier than predicting. Emotional buying creates false strength because emotions in the market always show up as urgency, not as stability. When traders are calm and confident, they buy slowly, they scale in, and they let price come to them. But when traders are emotional, they rush. They hit the buy button without thinking. They don't care about price. They only care about being in. That rush creates sudden spikes on the chart that look powerful, but they are built on fear and excitement, not on solid conviction. You can usually feel emotional buying before you even see it on the chart. The news is loud. Social media is buzzing. Everyone is talking about how something is about to explode. That noise pulls people in. They don't want to miss out. They imagine the profit they could make if they just get in right now. That imagination is what drives emotional buying, and it is a terrible guide in a market that rewards patience. On the chart, emotional buying shows up as sharp moves, often straight up, often right into resistance. Price jumps so fast that it feels like something big is happening. But if you slow down and look, you will often see that the move has no base. It didn't build. It didn't pause. It just leaped. That kind of move has no foundation, and without a foundation, it can't last. True strength in the market is quiet. It builds over time. It respects levels. It pulls back and holds. Emotional strength is loud. It breaks levels in a single burst and then waits for applause. The problem is that markets don't applaud. They test. And when they test emotional buying, it usually fails. When traders buy out of fear of missing out, they are not thinking about risk. They are not planning where they will get out if they are wrong. They are thinking about how much they could make if they are right. That mindset is upside down. In trading, you must think about what you will lose before you think about what you will gain. Emotional buyers do the opposite, and that is why they are so easy to trap. The market knows where emotional buyers live. They live above obvious levels. They live after big green candles. They live where excitement is highest. When price runs into those areas, the professionals are waiting. They use that emotional demand to sell. That selling absorbs the buying pressure, and that is why price stops moving even though everyone feels bullish. This creates the illusion of strength. You see high volume. You see big candles. You see lots of participation. But underneath, the buying is being matched by selling. The market is not lifting. It is being held up by emotional money that will eventually let go. When emotional buyers realize price is not going higher, they start to feel uncomfortable. They bought at the top of the excitement, and now the excitement is fading. That discomfort turns into fear, and fear turns into selling. That is when the false strength collapses. This is why you often see fast drops after fast rises. The rise was emotional. The drop is the reality. It is not that something new happened. It is that the emotional support was removed. A disciplined trader learns to spot this. He sees a sudden spike and asks, is this real strength, or is this just people chasing? He looks for follow-through. He looks for pullbacks that hold. He looks for price to prove that it can stay up there. If it can't, he knows the move was built on emotion, not on commitment. This also connects to your money mindset. Emotional buying is about wanting something now. It is the same impulse that makes people overspend, overtrade, and take risks they can't afford. When you let that impulse guide your trading, you are putting your capital in danger. When you resist it, you are protecting your future. Markets are designed to exploit emotion. They move in ways that trigger fear and greed. The trader who survives is the one who does not let those emotions dictate his actions. He watches them in others and uses them as information. Emotional buying tells you where the crowd is. It tells you where they are most hopeful. And hope is not a strong foundation for a price level. When that hope breaks, price moves fast. You start to realize that you don't need to be part of every move. You only need to be part of the moves that are built on real participation. That means institutions, long-term players, and people who are willing to hold through noise. Emotional buyers are not willing to hold. They are only willing to dream. When you wait for emotional buying to exhaust itself, you often get much better entries. You get to buy after a pullback when the excitement has cooled and the price has shown it can hold. Or you get to sell when the emotional buyers are trapped and starting to panic. This is how you turn other people's feelings into your edge. You don't have to predict the news or the economy. You just have to watch how price behaves when emotions run high. Over time, you become less reactive. You stop jumping at every green candle. You stop feeling the urge to be in the market all the time. You become comfortable waiting for the moments when the crowd is acting foolishly.